I'm Debbie Caylor. I have Lakes Area Realty, realtor, been selling real estate in this area for 25 years already. It makes me feel really old, you guys. I also authored the book, Ultimate Guide to Buying and Selling Real Estate in the Willmar area, so you should get a copy for coming here tonight. What caused me to write this book is this process can be really stressful, or it can be, I mean, there's always some stress involved, or it can be a little more enjoyable. And what stresses people out is not knowing where to start or what to do, right? I mean, you don't know if you're going to qualify, and a lot of people put the cart before the horse, where they start looking at houses and then find out later they can't buy a place after they've already fallen in love with it. So I have Tracy Lundy from Lake Region Bank with me tonight. Excellent loan officer that I love working with. They have an office right across the street and one in Willmar, so very convenient. Tracy's great to meet people either at her office or mine, whatever works for you. She's pretty flexible. But she can put you on the right path and tell you what the best loan program for you to follow would be.
So I'm Tracy Lundy. You guys have met me before with Lake Region Bank, and I've been doing this for 17 years. So I've been around the area and have done this for a long time. So today, I'm just going to talk about just kind of the basics, the mortgage process, and then if you have more specific questions, we could do that later. Scroll down here. And so by starting with the basics, I'm just going to talk about the application. And there's many different ways that you can apply with us because we're really flexible and accommodating and try to cater to everybody's needs. So we do have an online application, and this small little graph shows you that you can go to lakeregion.com and click apply now and apply for the home loan, and it shoots me an email, and then I'm able to work at it in my office and give you a call. You can also come and meet me in person. You can call me and I can take your application over the phone, or I can send you the application or email you the application, however it works. I'm also available for evening and sometimes weekend appointments if that's the only thing that works for you. And things that you'll need to apply for a loan is we need your name, your social security number, your date of birth, we need a 2-year address history, we need a 2-year job history, we need to know what your assets are, so what you have in the bank, if you have any retirement funds or mutual funds, and what your debts are. And the 2-year job history, we need to know your job history for the last 2 years, but you don't always have to have been employed for 2 years. For instance, if you're a recent college graduate just getting your new first real job, then we count your your time as a student kind of as a job. So then we would verify since both have transcripts. Then the second step is that we pull credit, and we look at the credit score. And everybody has 3 credit scores because in the mortgage industry we pull all 3, Equifax, Experian, and TransUnion. And what we do is we go off the middle score. Or if we have joint borrowers, we take the middle of the lowest. And that's just an industry-wide standard. And our target is usually 640. 640 is usually the lowest score we can work with. Unless you're a veteran and you're applying for a VA loan, then we can work with a 620. The other thing that we look at is when we analyze your application, is your debt to income ratio. And for the program that we do the most, which is rural development or first time homebuyer program, the zero down program, they like to see your housing ratio at 29% or below and your total debt ratio at 41% or below. And I put together this very high-tech chart to show you kind of what we do in a nutshell. Okay, so we'll just, for instance, if your monthly income, and we use the gross income, is $2,400, we look at your housing expense, which P&I is your principal and interest payment, so I just put $450. And let's say your insurance and taxes are each $100, and the rural development fee is $50, so you have a total payment of $700. Well, what we do is we divide the $700 by the $2,400, so right here, and you get 29%. So a person that makes $2,400 a month, the max mortgage that they can qualify for would be $700 a month. Then we look at your total debt to income ratio. That's the what we call the back end ratio. And we take all of your other expenses. So SL here, that's student loans. Let's just say you have student loans of $100 a month and credit card debt of $100 a month. So that's $200. So you have the $200 and the $700 for a total of $900 in monthly payments. And then you divide that by the total gross income and you get 37%. So if we can go up to 41%, then this person can actually have a little bit more debt and still qualify. So that is how we figure out the monthly debt to income ratio. There are a few other things that go into the debt ratio. It's mostly just things that show up on your credit report. So student loans, credit cards. The other thing that would get figured into that is if you have to pay child support. But utility bills, cable bills, phone bills, anything like that, that doesn't get included in here, or daycare. So it's only things that where you've actually borrowed money from somebody or have a child support or alimony obligation. And then the third step is everything is automated these days. So if you pass all those tests, you know, your credit score is high enough and your debt to income ratio looks good, you've got enough credit, then we actually send it through an automated underwriting system. And pretty much every type of mortgage there is has an automated system. So I enter in all your information and then I send it out there, and then an actual computerized and underwriting engine, so a computer brain, analyzes everything that's been input into that application and the credit report and comes back with an approved, or they call it an accept or an eligible, to let us know that you're eligible for that type of loan. And there are some products where we don't have to do that, and I can talk about that later too. So that's kind of the third step, and once you get the approve or accept, then you're good to go. As long as the loan officer put everything in the correct way. Now if we don't have, sometimes we don't have all the information to give you an answer right away because you might be self-employed. So I might say, well, come back to me with your tax returns. Or I might want to see some more information, like your pay stub, like you might get a lot of overtime, you might get commission income, you might get tips. So if there's some income out there that I think I still need to kind of look at before I give you approval, then I'll ask for additional information. And I might even ask to verify that you paid your rent on time. So then after the process of applying an approval, I just thought I'd spend some time talking about the different types of loans. And I'm actually going to start here at the bottom, rural development, because I do mostly, or the majority of the business that I do is for first-time home buyers. And the USDA Rural Development actually offers a program to first-time home buyers that is $0 down. Now, every loan, if you do not have 20% down, your loan needs to be insured or guaranteed by somebody. And that's where the USDA Rural Development comes in, because they guarantee the loan. It also means insure the loan. The VA insures loans, FHA, and then conventional loans, if you don't have 20% down, you can get private mortgage insurance. And what that insurance or that guarantee does is if for some reason you stop making your payments and you default on the loan, then these different organizations, the mortgage lender files a claim with them, and they pay the lender back a percentage of your loan. So they're willing to do a low down payment loan or no down payment loan to you because they have some insurance on the loan that would recover some of their costs if you defaulted. So I'll first talk about the rural development loan because that's the most popular one for first-time home buyers. And it's the one we go to first because it's $0 down. I should also say you don't have to be a first-time home buyer to use it. You just can't own another house. This program is also income-based. So if you're a family of 1 to 4, you can't make more than $81,200. But they also let you account for children and daycare. So let's just say your family household income is $90,000, but you pay $10,000 a year in daycare. Well, we can use that daycare to offset and to bring your income down so you qualify for that program. They also, all of these organizations pretty much charge a fee. This guarantee is not free, but they let you borrow the fee. So for instance, the USDA Rural Development charges 2% upfront. So if you buy a house for $100,000, you're going to pay $2,000 to guarantee your loan. So your loan amount will actually be $102,000. And then they charge an annual fee that gets collected each year. Actually, it's monthly with your payment. The VA charges a fee. I mean, they basically all charge an upfront fee. They all kind of work the same. Unless you are a disabled vet, then they don't. We also, if you've heard us talk about the first-time homebuyer product, our bank, we partner with Minnesota Housing. And Minnesota Housing is the actual lender on it. And we partner with them because they offer a first-time homebuyer interest rate. They also offer an interest rate that's called a step-up rate for a second-time homebuyer. And typically those rates are below market rate for low to moderate income borrowers. So if you hear us talking about Minnesota Housing or first-time home buyers, that's who we're going through to get those loans. A VA loan is a really good loan and probably one of the cheapest loans. It's also zero down. There is an upfront fee unless you're a disabled vet, and the closing costs are lower on those because they regulate how much a veteran can pay. And the veteran does not pay any annual fee or monthly fee for the loan once they get it. And then if you make too much money to qualify for rural development, but you don't have very much down, the next program we would go to would be FHA. And FHA used to be the most expensive loan, but they changed it now this last year to make it a little bit closer to rural development. FHA is, kind of my second choice because it is 3.5% down. But the nice thing about it is they allow that all to be gifted money. If you have a relative that could gift you the 3.5% down. So FHA would be next. And then conventional is one of our other options. Conventional we usually go to when people have close to 20% down or 20% down. Because if you have 20% down, your loan doesn't have to be insured. And you can just do a conventional loan. So that's really one of the best ways to go and the cheapest ways to go if you have 20% down. The other nice thing about our bank is we're direct lender with Fannie Mae. So a lot of those conventional loans with 20% down, we actually keep them and service them in-house. And so people end up making their payments to our bank instead of getting sold. And then, I'm going to mention one other loan. We didn't put on here, but we also do in-house loans. And there's some people that just do not fit in the box. They don't fit in any of those loan boxes. And so we can get a little creative and do an in-house loan. An in-house loan is where we fund the loan. We fund all of our loans, but we fund the loan and we keep it. And when you have to do an in-house loan, it's usually if you need a cosigner, because a lot of these products don't allow cosigners. If you're doing a construction loan, if you're building a house, maybe we just recently had one where the son didn't qualify on his own and didn't have any down payment, so his dad gave us some of his land as extra collateral. So there's some different creative things that we can do with in-house loans. And sometimes it's a temporary thing until the person could maybe qualify. So we might do that loan knowing that it's only going to be a year or two, and then we're going to refinance them and put them into a conventional loan. So it's nice to have that option available to us. So now let's just say you're approved and you go with a realtor and you start looking at a house. So I thought I'd talk about what happens when your offer is accepted. When the offer is accepted, what happens then is the realtor sends me the purchase agreement, and then all the wheels start going in motion. Then I print out at that time a bunch of real estate disclosures. It's a big, thick pile of real estate disclosures that you need to sign. It's basically your banker is providing you information, and when you sign, you're acknowledging that you got the information. So it's a lot of forms that talk about closing costs. They talk about a lot of different laws that are in place for your protection. Talk about what insurance requirements you need, but just pretty much everything you need to know about the loan is in that paperwork. And then, once you sign those disclosures, you may choose to have a home inspection. And home inspection is something that we don't require for our loans, but a lot of people do just for their own protection. So the inspection is optional. But then we do require an appraisal. And kind of the difference between the two is the inspector really goes and looks at the house. They climb up on the roof, they test all the appliances, they look at the foundation, they really go over it with a fine-tooth comb and give you a report. The appraiser is there mostly to justify the value. You know, if you're buying a house for $100,000, is it really worth $100,000? So what they do is they go out in the neighborhood, in the community, and they find other houses that have sold similar to yours. And then they try and come up with a value to show that the house you're buying is worth what you're paying for it. Because as a bank, we need to know that the collateral is worth what we're borrowing for. So we order the appraisal. Then we order this stuff called title work. And title work is done by a title company or attorney's office. And that's really important because what the title work and all those searches does is it shows that you have the first lien to the property, you and the lender. So they search the courthouse, they do lots of searches because they're looking for old tax liens, bankruptcies, judgments, different documents that didn't get recorded the correct way, anything that could encumber or cloud the title so that you may have an issue in the past. We want to make sure that that title is clean. Now, things get missed every now and then, or things pop up later on. So the lenders require that there is actual title insurance. So these title companies, once they do all those searches and everything, you have to pay for what's called lender's title insurance. And that is if the lender ever gets your house back, then and they have to sell it and there's a title issue, then that title insurance kicks in and they correct it for anything that's wrong with it. And then they also give you the option of buying owner's title insurance for a really reasonable price at the same time that would protect you if a title issue ever came up. And then, once all that's done and we've gathered all your information and made sure that we verified your employment, we verify your assets, maybe sometimes we have to find some alternate credit, then we send it to underwriting. And we work with several different sources for underwriting, but usually we have somebody in our bank. We sometimes email all this stuff and people off-site look at it. So an underwriter, what they do is they take the whole loan package, they take the appraisal, the title work, all of the stuff that we verified, and they look over it and they make sure that it meets all of the terms and the guidelines. And once that's all done, then they give us our clear to close. And then you can go to the title company and sign the paper, and then the house is yours. So that's kind of the process. And I should back up a little bit too and talk about closing costs. Because a lot of first-time home buyers don't have the cash to pay their closing costs either. So how do you pay for those if you don't have them? Well, a lot of times what they do is they ask the seller to pay the closing costs. And now the sellers usually know in their head how much they want to make on a house. So a lot of times as a buyer, if you offer the seller a little bit more money, they might be willing to pay your closing costs. And how that helps you out is my loan amount is based on the purchase price, okay? So if the purchase price is $100,000, that's all I can borrow you. If you've actually written the closing costs into the purchase agreement, and let's just say you wrote it for $105, now I can write it for $105, and then I can borrow you that extra $5,000 to cover the closing costs. And how it looks on the seller's end is you wrote it for $105, he's paying $5,000 towards your closing costs, and so he nets the $100 that he really wanted in the beginning. So basically, you're offering the seller more money to pay your closing costs, but in the end, you're paying them because you ended up borrowing more money because you made the purchase price a little bit higher. But that's how a lot of first-time home buyers do it. Debbie, would you say that?
Definitely.
Because a lot of first-time home buyers come to me and I say, how much money do you have to work with? And they might have $500, they might have $200, they might have $1,000. And closing costs are a lot higher than that. And so that is the best way to get them included into your loan. So any questions at this point regarding the process?
Okay.
All right, so I'm going to talk about now some credit issues. And one that I see a lot is, especially with first-time home buyers and younger people, is no credit or limited credit. The RD program requires that you have at least 3 trade lines that are reported on the credit bureau for 12 months. So Even if you have a good credit score, but you only have one trade line, that doesn't mean that you can still get the loan. So what happens then is we can go out and we can verify non-traditional credit. And so we'll ask you, do you pay rent? We can verify your rent. Usually we like to see canceled checks for that. Or if you rent from a management company, we can send a verification form to them. We might ask, do you pay utilities? Do you pay cell phone? Do you pay doctor bills? And you can verify all those things. So if we can get at least 3, then actually it's 3 if you have rent, 4 if you don't have rent. Then we can pre-qualify you for that type of loan. If you have a low credit score, there's lots of things that you can do. A lot of times people's credit score is low, maybe because they're young and they're new. It might be low because they have very limited credit. So usually what we recommend, because you have to have a 640. If you don't have a 640, we can't even verify non-traditional sources. So if you need to get your credit score up to a 640, a lot of times what really works well is if you have a credit card and it's close to the maximum balance, you need to pay that down so that it's at 40% of your credit limit. Or you might need to open a credit card and use it for a few months until your credit score goes up so you can build some more credit. And there are credit cards out there for people that can't qualify for a traditional credit card. They're called secured credit cards. And we've got one on our bank website, and then otherwise you can just Google secured credit cards. And what they are is they're a way for people to establish credit. You send the credit card company collateral or security, which means like $300 usually. That's your credit limit. And then you use the card just as a normal card. So what I recommend people do is they open the card and then they just charge one thing a month. So they just charge gas and then pay it off. And then they charge it again next month, pay it off. And it's not a fast way to build your credit score, but you will see a decent credit score, after 6 months. And where your credit score really gets good is after you've had credit longer than a year. And the credit agencies really like to see that you can manage different types of credit. So they like to see that you have installment loans, which are car loans or student loans. They like to see credit cards, and then the other one would be a mortgage. So, but people can have really high credit scores without having any credit cards if they just have student loans or bank loans or only having credit cards. As long as you make your payments on time and keep your balances low, your credit scores will always be good. Some other issues that I see are collections and judgments. Collections, we typically like to see them being paid, but there are some circumstances where we will allow them to remain open, like if they're old and you just can't track down the creditor to figure out who to pay. So that is kind of a case-by-case basis, unless the balance is really high. And then judgments always have to be paid, because a judgment is something that somebody took you to court over, and a judgment can be a claim against your house. So if you buy a house, somebody that has a judgment can file a judgment against the house. So if there are any mortgage companies out there, they'll let you buy a house if you have any outstanding judgments. You always have to get those paid. And I think that is the end of my presentation.